Hello, friends and families all over the world. It's your prophet, Prophet Linford Wilson, another time on Secret Diaries. One thing that I want you to know today is knowledge is the acquisition of information, and wisdom is the ability to use knowledge skillfully. And I'm here to announce to you that these two corporate streams of knowledge and wisdom is about to reflect itself within the conversation that we'll be having. We had a very wonderful guest that was talking about how to become a millionaire in our lifetime. And I believe each and everybody all over the world was blessed by the information that he was giving to us. But he said to me that, Prophet, there's a new idea that I want to put into the system and in the heart of men that can take them to the next level. We discussed about this wonderful system. And in fact, when we were talking about this system, I was so happy to have that knowledge about it personally. And I took it in my heart that I don't want to be very selfish to have this knowledge alone and leave everyone, especially the Secret Diaries family. And I invited him again to this wonderful platform. And I'm going to mention his name because of respect. We are having our platform today. David, welcome. He said he's not old, he's young. And I need to hold that word very, very well. So in the previous episode, as we had our guest, we were so blessed concerning the contribution that he never kept as a secret, but released or unveiled the secret to the heart of men to run in by faith, to activate what is within their potentials. And today, we are about to enter into another section in connection to what we discussed in our previous episode. So, I will do this introduction again to welcome him. Mr. David, welcome.
Prophet Linford Wilson.
Bless you for coming on this platform.
I'm absolutely thrilled to be here because I know that we're going to make an impact in a lot of people's lives.
It's so surprising that as the first video was placed on the YouTube platform,
yes,
we had about thousands of people that were watching.
Fantastic.
And I discovered that your message really blessed the lives of people.
Praise God. That's
and
right.
I'm believing that today, on what we are going to discuss, many will be blessed.
Amen.
By the light message that we are about to unfold.
Yes.
Friends and families, what we'll be discussing, some of you may have some understanding concerning it. Some of you also, there is the new mood of creativity in knowledge that you are going to use to produce results in your life. I want you to stay connected with us as we unfold our topic today. God bless you. Mr. David, welcome.
Good day, sir.
We had some few conversations.
Yes.
On phone. And it was so interesting. And this is the platform that we share this secret out.
Yes.
I want us to look at something very, very important. Today, the topic actually is cash flow quadrant. Now, under it also, there's a connection of creating wealth through property investment.
Yes.
Can you explain these two core points for the viewers?
Of course. On our previous episode, we discussed the cash flow quadrant, and that is on the left-hand side of the quadrant. There's two quadrants, first and second. The first is employee, the second is self-employed. On the right-hand side of the quadrant is business owner and investor. On the left-hand side of the quadrant, we work for money. We go to work, we put in our time, we work for money. On the right-hand side of the quadrant, money is working for us. And to be wealthy in this world, we can't just be using our hands on an hourly rate. We need to be somehow leveraging our time and leveraging our money. And the fourth quadrant in the cash flow quadrant is investor. And today we're going to be talking specifically about real estate investment. building wealth, creating wealth through real estate investment.
Viewers, there's a time that if you have some few comment, you can write down your comment. We'll look into it and also get back to you. So as the information is about to flow, which has started, listen carefully. Whatever thing that you don't understand pertaining to the journey of this information, you can write it down and we'll get back to you. Mr. Welcome. In fact, you look so wonderful.
Thank you very much, Prophet.
Now, in connection with the recap of cash flow quadrant and creating wealth through property investment, there were some few things that we discussed.
Yes.
And I want us to look through them. When we talk about corporate structure and liability, what does it mean?
Sure. So when you do business in this world, you do business through an entity. It's either a sole trader entity, a partnership, a limited liability company, a trust structure, limited liability trust structure, or a trust, a business trust. So there are different entities that you can utilize to do business through. And the law has given us the ability to have limited liability in our dealings with other people, with other businesses. So if we're doing business with other businesses, we're trading, we're selling goods and services, whatever we're doing. Sometimes we don't always do everything 100% right. And so the law has given us the ability through these different corporations to have limited liability. In other words, the assets that are in the corporation that we are working through are the assets that would be available in the event that there's a decision and it's a wrong decision that's made. Someone sues the company, and the company, there's a judgment made at the court. A judge passes down a sentence to the plaintiff against the defendant, being the company, and says, well, you made a mistake. You have to pay certain monies out in recompense for the wrongdoing that the company made. And so therefore, you cannot put all of your personal assets into that pool, because if you put all your personal assets into that pool, you would lose everything. If there's a decision made which would take away all of your assets. So corporations, limited liability companies are set up there to enable business people to trade in such a way that the company, if it has assets, it will pay the debt. But if the company doesn't have the assets, the owners will not pay the debt. The company will only pay what it can. So that's why it's called limited liability.
Okay. That is so great. Also in our discussions, you listed out some points which I believe that the viewers would like to understand in the basis of what sole trader is, what partnership is, what limited partnership is, and what else. You were mentioning some kind of structures.
Sure.
So I would like you to go through those structures.
Sure. Well, these are structures that business people employ to do business. And a sole trader, starting with a sole trader, is a person who registers a business name and does business through that business name. That is a sole trader, a person on their own. Then we have a partnership, which is two or more people doing business together. And normally they have a partnership agreement, which outlines what the partnership will do, what the responsibilities of all the partners are, what the remuneration of the partners will be when they do business. Those two structures, a sole trader and a partnership, are not very good structures actually, because there's no limited liability. They have unlimited liability. So in the event that a debt is incurred by a partnership, for example, then the debts of the partnership are equally and severally liable on all the partners. So it would be Mrs. Smith or Mr. Jones or whoever it might be in the partnership. It might be 10 people in the partnership. They all have to dig into their pocket to pay for whatever liability the partnership incurs. If a mistake's made, if the partnership is sued, for example, if the partnership has their joint assets are $1 million, for example, then the plaintiff can ask for each of the partners to dig into their pocket, sell their house, sell their car, sell other assets, business assets, in recompense of the debt. So it comes back personally on the partnership, on the individual partners of the partnership. So there's no liability there. You see, they have to dig into their own pocket. Where business is being done through a corporation or a limited liability company, well, then there's limited liability based on the paid up capital and the assets of the company.
Wow. So right now we've got to know what a sole trader is.
Yes.
And we've also got to know what a partnership is.
Mm-hmm.
And we've also got to know what a limited partnership is.
Yes.
So let's look at what LLC is.
Sure.
What is the full meaning of LLC and what is beneath LLC?
Sure. A limited liability company, LLC, limited liability company, is a company that has limited liability. And a company is operated through its memo and articles of association, which is the terms and conditions that the company is operating under. It's called memo and arts of association. So the company will be directed by the directors according to the memo and arts of association. So in those articles of association, the company has limited liability. It has a certain paid up capital. And in the event that the paid up capital is not sufficient to pay a debt, well, then the company will become insolvent. And if it becomes insolvent, the company will go out of business. It's that simple. An individual person, like in a partnership, if the partners don't have the money to pay a debt, then the partners can file for bankruptcy. But if a company can't pay its debts, a company will file for insolvency. A company becomes insolvent. Partners become bankrupt, basically, personally bankrupt. So the reason we have a limited liability company, as in limited liability of asset protection, as opposed to an individual or a partner in a partnership, the assets of the company are put up in recompense of a debt, a judgment debt, okay? But the limited liability company only puts up the assets that the company has, that the company owns, controls, paid up capital assets that the company owns at any particular point in time. It doesn't flow through to the owners.
Okay. Thank you so much. So what goes into corporation?
Corporation is similar. In America, we have the C corporation and the S corporation. They're very similar too in terms of asset protection, in terms of limited liability. One of them is more tax effective than the other, but essentially corporations again are a limited liability structure.
Wow. Viewers, it's so interesting. I believe that you are gathering information for the next level for you to act in faith through real estate, right?
Yes.
God bless you so much. The next thing that I want to talk about is trust. What goes into trust?
Sure. A trust is a legal device to protect assets, or to hold assets, I should say, to hold assets on behalf of beneficiaries. So usually you'll find that a company will be a trading entity. The company will trade, it will sell carpets, it will sell vehicles, it will sell hotel rooms, it will sell all sorts of different products and services. But a trust is a device that holds assets. And quite often a trust will hold real estate assets, it will hold other valuable assets that belong to the beneficiaries of the trust. And a trust is governed by a trust deed, and the trust deed dictates how the monies of the trust will be dispersed in the event that the trust becomes vested, what we call vested. In other words, it comes to an end. Then the assets of the trust are dispersed to the beneficiaries of the trust. The trust has a trustee, and the trust has a principal as well, which is part of governing the trust.
Wow. Viewers, truth breaks slavery. Truth breaks bondage. I believe you are gathering strength by the information that Mr. David Wakame is giving. I would like you to be writing your comment down, and we'll get back to it by the close of this episode. God bless you. Mr. David, what is foundation? What goes into foundation?
Okay, a foundation is another legal device which holds assets. A foundation is an entity, generally speaking, that would transfer assets from one generation to another. Yeah, it's above a trust. It would hold assets long term, a foundation, for a family, for a rich family. But we're talking here about all these different structures. I think most of the audience today wouldn't really be interested in a foundation.
Okay.
Most of the audience here would be interested in the first maybe three, which would be the sole trader, the partnership, and the corporation or limited liability company.
Okay.
Yeah, they're generally the entities that are used by small business people, by medium businesses, people who are entrepreneurs and are doing business. Yes.
Wow.
And generally speaking, you would find that a corporation would be trustee of a trust. Limited liability company would be trustee of a trust, not a person. Although a trust deed, the principal would be a person, but the trustee may not be a person, it may be a company. And the reason for that is you don't want the trustee of a trust being sued as a person, because if the trustee of a trust is a person and they get sued, they can lose their own personal assets. So we normally have, generally speaking, we have a trustee company as trust for the trust vehicle, which gives limited liability all around.
Wow. In fact, viewers all over the world, when we talk about properties, real estate, there's a lot of things that goes into it. That is why you need knowledge for you to gain your grounds to move by feet. Mr. David, welcome.
Yes, Prophet.
Today I'm going to really worry you with a lot of questions.
Okay, I'm ready.
Because I believe that after this show, I need to start working on real estates.
Amen.
Okay, let's go into deal making. What goes into deal making?
Okay, so let me just say, first of all, we just step one in your career as a real estate investor.
Okay.
Step one is creating wealth through real estate.
Okay.
Step one is having the right entity.
Okay.
That's why I think we've discussed the entities here, because people need to know if they buy some real estate in their own name, as we just discussed, sole trader or partnership, well then those assets are fair game for someone who wants to sue you and take money from you. So, you know, that's why we talked about the entities up front, because you need to get your structure right before you start investing. Once you've got your structure right, then you can start investing. So then you have your structure right, then you say, okay, now I'm ready to go. I'm ready to start. So then you start deal making. You're looking for a deal. You're looking for something to get into, some investment somewhere in real estate. And as a deal maker, you know, you could be just a passive dealer in real estate where you just buy an asset and you set and forget. Okay, you buy it, you invest in it, and all you do is you manage the cash flow. But then the other side of the coin is someone who's more aggressive and wants to get, you know, going in their net worth. We talked about net worth as well in our first discussion. Someone who wants to supercharge their net worth. Okay, they don't just want to wait for 10 years for inflation to increase the value of that asset. They want to get in and they want to create, you know, a lot of increase in that asset very quickly. So there's a way to do that. So a deal maker is more the person who would buy an asset which is undervalued and would somehow create value in that asset through IP.
Okay.
Through understanding real estate, and we're going back into this, I think, as we go through this discussion, we're going to talk about how to do that. But that's what a deal maker will do. A deal maker will supercharge the growth of the asset through specific strategies, whereas the person who is a passive investor, like a share market investor, will just buy the shares and they'll put them in the drawer. They might be a blue chip share. Oh, this is fantastic. You know, I bought these shares, I put them in the drawer. In 10 years' time, I'm sure Microsoft will go up another 10 times. I'm sure Warren Buffett's company, you know, Berkshire Hathaway will go up another 10 times. You know, they just throw it in the drawer. They're very confident in those shares, you know. Whereas someone who's more supercharged would be trading those shares and getting gains every month on those shares. They'd be more active. Same in real estate. We are more active. We are looking for opportunities, for the right opportunity to create value. And that is a skill. You can't just get that skill straight away. You need to study. You need to get that skill through study and application.
Wow, that is so wonderful. What goes into landlording and flipping?
Yes, okay. So you have two methods of dealing with real estate, okay? You either are, creating something from the asset, on a short-term basis, which is flipping. Okay, so for example, a flipping would be if the market was rising in a certain area, and I saw a house, for example, and the house was say $100,000. Okay, and I knew if I renovated it to a point, I don't want to spend too much money, but if I renovated the house, maybe I painted it, I fixed up the front fence, I did the front landscaping, I lifted the front of the house to make it look really pretty. And then I did some minimal things inside. Maybe I put new doors on the kitchen, a new bench top. Maybe I did some tiling, I did some painting, But at the end of the day, we're not spending too much money, but the market is rising. Okay, the market is rising. So you're doing it while the market's rising. So you're thinking, I'm going to flip this property. Flipping means you are buying it at a price and quickly flipping it for another price. Okay, so you're buying it for $1 and then you're flipping it for $1.50. You're making a 30, maybe 40, maybe 50% margin quickly.
Wow.
Whereas other investments, you would make it over a longer period of time.
Wow, it's so interesting actually.
Yeah, so landlording then is where you buy the asset, or you've done a deal. You're not going to flip it. You're going to keep it now. And you could be what I said before. You could be a passive investor, or you could be an active investor. You could be passive in the sense that you're a landlord now. You own a property. You've got tenants in that property. So you now have income coming in through the rents. Okay, so you're a landlord. Okay. The other side of the coin is where you're still aggressive. You are building wealth. You are building equity in the asset by, as I said before, by painting, by fixing up, and then you put tenants in there at a higher rent, because the rent before, the property wouldn't achieve much rent. But now that you've fixed it up and you've made it pretty and you've put a lot of services inside there that will benefit people, they'll pay more money.
Wow.
So now you're landlording that property. You're not a passive landlord. You're more of an active investor landlord. So you're now milking the cash flow. You're now receiving a lot more money because you've added more value to this property here, which you've just bought and you've set and forget. This one here, you've created an opportunity for yourself, and you've increased the value, you've increased the rent. You see, as you increase the rent, what we do is we recapitalize the value. That's what it's called. Okay. So if you buy the asset for $1 and you fix it up and the rents go up, the net cash flow is the barometer or the equation, if you like, which determines the value of the property. So if the value of the property today is $100,000, you fix it up, but the rents have gone way through the roof because you fixed it and you've got higher paying tenants. Therefore, the value is not $100,000 anymore. The value could be $150,000.
Wow.
The value could be $200,000, whatever it might be. So you're doing what we call forced inflation. Over here is passive inflation. Over here is forced inflation through using your knowledge and using your abilities.
It's so wonderful. Viewers, I'm asking my questions, and I want you to write your questions down. Give your comment concerning the knowledge that we are sharing, and we'll get back to that. Mr. Welcome.
Yes, Prophet.
I'm so happy with the information I'm pouring out.
Praise God.
And I believe that a lot of people are going to be blessed so much.
They will be blessed. Amen.
I want to ask to continue our journey concerning contract and clauses. What does it mean?
Sure. Okay, so we set ourselves up with our entity and preferably a limited liability entity. Okay. Then we look for an opportunity. We did deal making. We either bought a property to just set and forget, or we did more active investing where we fixed it up. We created an opportunity. We may not have fixed it up even. We may have just created an opportunity there. There's many ways of doing it, but I don't have time today to discuss all that. So then we move on to how are we going to buy that property? Through a contract. There's always a contract of sale, a purchase contract to buy that property. And how you structure the contract with clauses determines whether you not only have a good opportunity, but also you get an advantage. So certain clauses can give you an advantage. For example, one property I bought a block of 15 units, for example. I paid $500,000 for that block of 15 units. Now what I did is I wrote the contract with the agent, and I said to the agent, I will only pay $5,000 as a deposit. Okay. But I knew what I was doing. I knew there was an opportunity in that property because I had understanding with that particular property that I could create value in that property using my IP, my real estate IP, okay? Which comes back to the skill set we were talking about in our first session, the skill set. So what I did was I got a valuer to give me a valuation as is, a valuation, or what we call strata titling approval, and then a valuation as if complete.
Okay.
There's 3 valuations there. The first valuation is when you're buying it. Second valuation is on approval for what you want to do, your strategy. And the third valuation is everything done. The property refurbished, strata title finished, everything done. Okay. So I took it from 500,000 to 1.1 million in a matter of months. And the way I did that, and by investing just $5,000 up front, and the way I did that, I understand valuations and how you can create value within a property through using certain strategies. Okay. So all I did was I put clauses into the contract which said that I will not close on the contract until my building format plan of subdivision, which is a strata titling of all the units into individual entities, right, individual titles. I'm only getting an approval. It's not a settlement of the titles, it's just the approval. So by getting the approval, the value has given me a valuation of $750,000. And I haven't settled on the property yet. I'm buying it for $500,000, but it's now worth $750,000 before I even pay any money out, you see. So I've created $250,000 of equity, you understand, just by writing a clause in a contract that I will not settle until I have my building format plan of subdivision, and I've already checked with the valuer, how much is that worth? Oh, that's worth $750,000. Oh, that's good, because I'm paying $500,000 and now it's worth $750,000 just on an approval, you see. So I've created $250,000 just by using a clause in a contract.
Wow. Viewers, there's a secret which goes. Your secret is your power. And I believe you are being empowered by the conversation that we are having. Mr. Welcome, we are on the journey of types of contracts.
We are on the journey.
We are on the journey of type of contract, time payment, or payment at settlement, or a combination of special clauses and the creating of advantages. So I want you to look into this and explain it to me.
Okay, so you can buy a property, for example, you can put a deposit down, and then on settlement, which is normally in the Western world would be about 45 days, or it could be 30 days, or it could be 60 days, depends on what the parties agree to. Okay, you can settle quickly within 30, 40, 50, 60 days, whatever. But then there is another way you can do it. You can say, look, I will pay you so much money now, and I'll pay you in monthly installments over a period of time. And so therefore there's a mortgage created between the vendor and the buyer, the seller and the buyer. There's a mortgage created, and that mortgage dictates, it has terms and conditions around it, which determines when the property will be fully paid. Now, people who don't have a lot of money in Ghana, for example, they've asked me, say, well, how can I buy a property? I don't have any money. I said, well, you can buy a property. Even if you don't have a lot of money, you can buy a property. And they said, well, how can I do that? And I said, well, look, there are vendors in Ghana who have built a house 3/4 built, and they are sitting there for 5 years uncompleted. And so the vendor is thinking, oh, I can't put any more money, I don't have any more money, or my wife has left me and I don't know what to do with it, or it was my aunt I was doing it for and she's not got any more money, or whatever. So you can approach that vendor, that seller, or that owner of that property. You can say, look, I will solve your problem for you. I will finish the building but I want a mortgage, I want to buy it and I want to keep it, but I want to buy it on these terms and conditions. I want you to lend me the money to buy the property. They will actually lend you the money to buy the property. You don't need to go to a bank. You don't need to go to no, you don't need to go to a finance company. It's called the hierarchy of paper. We create paper through contracts. So we're going to create a mortgage with that vendor, with that seller, to buy his property off him. And what we want to do is we want to get the best terms and conditions possible. We don't want to pay out a lot of money. We will fix the property up, because that would be one of the things he'll want seen done, because it's been sitting there for so long. He'll say, well, just if you can fix it, that would be fantastic. And you can sell it to the vendor on the basis that, look, it's been sitting there for 5 years. It's been rained on. If I fix it up, the value of that property is going to go up maybe 40 or 50%. So you're in a very strong position as the mortgagee. See, he would give you a mortgage. You become the mortgagor. He becomes the mortgagee. So he gives you paper saying that you can buy this asset off me at a certain price on these terms and conditions, and then you're the mortgagor. You will pay payments to him over a period of time, and you will amortise the debt that you owe him over a period of time. This can happen in Ghana right now. This can happen in Africa right now.
Wow.
It happens all over the world. Happens in Australia, happens in America, happens in the UK, in Europe. Slightly different in different countries, but this essentially is what happens.
Wow.
So these are the terms and conditions, setting up mortgages, in Australia we call it vendor finance. In other parts of the world they call it under different names, but essentially what it is, it's a mortgage that the vendor becomes the bank, if you understand. The vendor now is the bank, not your finance company, not your traditional bank, which is going to charge you 20% interest or 25% interest, whatever they're going to charge you. I know it's very high in Africa. In the Western world, it's different, because we can go to our bank and we can get 5, 6, 7% interest.
Oh, wow.
And then the property will return maybe 10 or 12% return. So we can easily make the payment of the mortgage. But here, it's different. The rates of interest are much higher. So you have to be very careful how you structure the deal. And if you're doing a deal with the vendor and you're getting him to become the bank, you can say, I'm not going to pay you any interest. And people say, what? You don't pay interest? I mean, yes, I've already done it. I've already bought property. I don't pay interest on it. I bought property over 10 years. I've amortised it every month over 10 years. That's 120 payments over 10 years. And I've made an equal payment every year to amortise the debt over the 10 years without paying any interest.
Wow, that is so amazing. Wow. Now, let's journey into valuation.
Sure.
Let's deal with as is, also at approval and on completion. I want to know what entails these things.
Sure. Okay, so in the valuation world, banks, finance companies, lenders require a valuation on a property, because say you're buying the property for $500,000. Okay. The lender's not going to lend you $500,000 to buy the property, because they have what's called loan to value ratios, and those loan to value ratios are reflected in the risk in the market at the time and the risk of the person buying the asset that the lender has to lend the money to. Okay, so they call for a valuation. A valuation basically is, what is the property worth compared to a similar property over there, or a property over there. So if it's a 2-bedroom unit, say for example in Accra, what did those 2-bedroom units sell for last week? What did they sell for last month? So the value will collect what we call comparable sales. He will collect all that information, and in his report he will say the unit you're about to buy is worth $500,000 because this same unit or similar unit sold for $500,000 last week, last fortnight, last month. So we can safely say the value of this unit is $500,000. That's how valuation works. And lenders require the valuation because they work on what's called a loan to value ratio. They will only go to, for example, in commercial property, they might go to 60% loan to value ratio. In residential, they might go to 80%, maybe 85%, could even go high depending on the risk and how well they know the borrower. and what the borrower's assets are. If the borrower has plenty of assets and plenty of equity, they might lend a lot more. They might even lend 100%.
Okay.
Because what they'll do is they'll take security over another asset and they'll put that in the pool. And then they'll say, okay, overall our loan to value ratio is 70%, for example. And so they'll be happy. But they won't just lend 100% on one property because there's no margin for error. And they work on margin for error.
Okay.
Because if the market changes quickly, they can lose money straight away.
Okay.
And it's just prudent lending, you know.
Wow. On our discussion, you were talking about something about us in at approval on completion. I want that to be clear.
Sure. Okay, so that is a strategy that I use. Okay, so if you were to buy a property and you paid for the property and you settled quickly and it was worth the $500,000, as we were just talking about the comparable sales, that is a valuation as is.
Okay.
As it is right now. It's in the market, it's there, it's got some tenants in it. It's in a position where it's worth $500,000. So the valuer would give you a valuation as is $500,000.
Okay.
Right. Now, a valuation on approval would be where you don't have that same house. It's a different type of asset. Okay. And that particular asset might be what we talked about before with the vendor who couldn't finish his property. He couldn't finish building. And there's a lot of them in Accra. You see them all over the place. They've been sitting there for years. No one's got the money to finish them off. So you come along and you can have an opportunity where you say to the vendor, look, I'll finish that property off. And you go to your valuer and you say, look, if I spend this money and fix this property up, what's it worth, you know, on completion? And what's it worth if I somehow carve it up or subdivide it or do some other strategy in between the completion, right? What's it worth? And he might say, oh, it's worth, if you do this and you do that, it's worth another 200,000 or another 100,000, whatever. So that's the interim valuation. And then when you fix everything up that you're saying you're doing, the approval, the renovation, the kitchens, the carpet, the paint, everything, the landscaping, whatever you're doing, that's the on-completion valuation. So there's the three valuations, and the reason you're using the three valuations is because you're creating an opportunity for yourself. If you understand valuations and you understand certain strategies of buying properties, well, then you can use valuations to your advantage.
Okay.
Not all lenders will lend you the money against those sorts of valuations. They will just say, oh, no. You know, I will just lend you 80% on what you're paying. But then some other lenders are more creative. They will say, that's okay. I can see that you're creating a lot more value in that property and it's very quick and we know you. We trust you, we know you, you have good credit, so we'll allow you to do that. We'll allow you to use that valuation.
Wow, it's so interesting. Viewers, I want you to write down your questions. I'm asking my questions to him, and I want yours also be part of it, so that the next time we come, we can take your few questions and roll it out for your knowledge. Amen.
Amen.
I want us to journey into something so important. One of the interesting subtopic on leverage and creating people. What entails leverage and creating people?
Sure. So, okay, let's deal with leverage first. Okay. Leverage is the difference between debt and equity. So when you are leveraging into a property, you are not just using all your own equity. If you're using that unit example, 500,000, and you got 500,000 in your pocket and you pay for that property, there's no leverage. Okay. But if you buy that property where you put a deposit down, you put maybe 100,000 down, okay, there's 100,000 in equity you put into the property, and there's 400,000 in debt that you borrowed to buy the property. So you haven't spent your whole 500,000, you've only spent 100,000 of your own cash. The other is debt. The other part of that equation is debt. And that's called leverage. Okay, so you're leveraging your little bit of equity into a bigger property because you don't want to put all of your equity into that one property. You are keeping your equity here to invest in other properties or to do other deals. So you are creating leverage when you do that.
Okay.
Yeah.
Okay. What about creating of paper?
Okay. So creating a paper is different, okay? Creating a paper is where you are dealing with a vendor, for example, or you're dealing with some other entity, it would be someone selling a property where, as I said before, you are creating paper and he or she is becoming the bank. So you are writing a mortgage with that particular vendor, and you are borrowing the money in a sense from the vendor. The vendor is actually not releasing any cash to you because the vendor still owns the property 100%. Assuming there's no mortgage on it already, the vendor owns the property 100%. So the vendor can give you a mortgage on that property. He will say, well, give me a deposit of on the 500,000 unit example. Give me a deposit of 50,000 and I will lend you 450. And so the paper you're creating is the mortgage the bank would write with you if you were lending from the bank. But now we are dealing with the vendor. The vendor's now the bank, and we are creating paper, a mortgage, under terms and conditions where we are paying the vendor as the bank, and we are paying the vendor on terms and conditions, preferably that suit us. Otherwise, you wouldn't go into the deal. Preferably that suit us. And we would try and make it over a longer term. We'd try and get very low interest, and we would make it in such a way that would be favourable. Still to the vendor, but favourable, very favourable to us as an investor.
Thank you so much. Within our previous discussion on the phone, you were talking about something on debt and equity. I want you to go into it for me.
Okay, in a sense, we've just covered a little bit of that, the debt and equity scenario. Okay, but with loan to value ratios that banks work on or lenders work on, even if it's a private lender, he'll still work on the same ratio. It's called a debt to equity ratio or loan to value ratio. In other words, the value is 500,000 and the loan is 400,000. So the 400 on the 500 is the loan to value ratio. It's the loan against the asset of 500,000. The equity is yours. The 100,000 you put in is yours. So that's where the debt to equity ratio comes in.
Let's journey into mortgages. What goes into that?
Okay, so a mortgage basically is paper that's created by a bank to lend you money to buy an asset. And in this case, we're buying real estate. Okay, you will put a deposit down. The bank will lend you money to buy the asset, and then under that mortgage, the bank will have certain terms and conditions. This is your monthly payment. This is your default rate. If you default in not paying your monthly payment, you'll pay a higher rate, for example. This is what happens if you don't pay at all. We take the property back. We sue you, blah, blah, blah. We recover our money. So there's all those terms and conditions that go into a mortgage.
Okay, thank you so much. What goes into financing sources?
Okay, so financing sources are many and varied, but essentially you've got banks, you have finance companies, you have private lenders, you have investors who want to come in and do a joint venture with you. So there's a few different areas that you can look at when you are considering buying a property. Anybody who is a beginning investor, I would not recommend they leverage too high. If they're borrowing money, they should not leverage very high at all. I would suggest 50% would be a safe leverage, loan to value ratio that they should go in on their first deal. And preferably, I would say they should have a partner, someone who's a bit more experienced maybe and has more money behind them than they have, so that there's a lot of strength in what they're doing and when they're starting up. Because if they start and they choose the wrong property and they leverage too high, they can easily just go broke tomorrow. And then they'll have a bad taste in their mouth and they won't want to invest anymore. And that would be sad, because if they can start on their investing career, just step by step by step, they can create a very bright future for themselves.
Wow. Wow. On our discussion also previously, you were talking about something on hierarchy of people. What is inbuilt in that statement?
Sure. I think I've just discussed a little bit about that, about mortgages and paper, borrowing money from a vendor, borrowing money from different entities, finance companies, banks, etc., private investors. The hierarchy of paper is where you are building, you have paper at different stages. You have different types of paper that you're using to buy an asset. So, you might get some paper from the bank. You might get some paper from the vendor. You might get a personal loan as part of the mix from here. So you have different paper that you're creating or that you're utilizing to structure the deal to purchase the asset.
Okay. Friends and families, I believe you are really enjoying what is taking place right now. We left with a few time to close the program. Within that, there are few questions I would like to ask. And stay in tune with these questions. David, welcome. I want us to go into market and cycles. What entails market and cycles?
Sure. Okay. So the real estate market has cycles. Okay. There's long-term cycles, there's short-term cycles, there's other cycles that, say for example, Bo Polney, Bo Polney, P-O-L-N-Y. Bo Polney would talk about, he's a Christian cycles analyst, and that is the macroeconomic view. So if you're buying a property today and you know that the market's about to crash, okay, you need to understand cycles. You know, the market will go through a cycle every 7 years. And every 10 years, generally speaking, property doubles in value. And that's why landlording, in my opinion, is the best way to invest in real estate. Because every 10 years, you'll get a doubling of your value of real estate. You'll get a doubling of the rents. And if that's the case, then you are setting yourself up for the future. A very strong future with passive income you don't need to work for, which we talked about before. You know, working for money and making money work for you. So we're now generating passive income we don't have to work for. And that's how it's done.
Oh, that is so interesting. You were saying something about 60-year K wave.
Yes.
What does it mean?
Okay, 60-year K wave is where the market completely changes, the economy completely changes every 60 or so years. It's called the long-term K wave. In other words, you've had the ups and downs along the way, but then in 60 years, there could be a depression, or there could be a financial recession, which will absolutely drop the value of your property from the $500,000 unit example, maybe down to 300 or 350,000. So the value of your unit has dropped. It's dropped way down. So you've got to understand the cycle, the long-term cycles and the short-term cycles. You can't just be thinking, okay, I owned that property, I owned that house. In 100 years, it's worth all that sort of money. No, because along the way, there are dips and there are rises, you know, along the way. So you need to account for these cycles, and you need to account for the long-term cycles and understand, you know, your position when you were starting in the market. Is it the right time to start now? Should I wait for 10 years? Well, you wouldn't wait for 10 years. You would do deals, you know, based on what the market's doing. You know, if it was going to be dangerous, you would put a lot of equity in. You would not have a lot of debt. You would have minimal debt on your way in. In that market. If you're moving into a dangerous period of time economically, for example, like the world is going into right now, you wouldn't just be leveraging up very high. You'd be keeping your mortgage at a very safe level, and you would be thinking, okay, then this big cycle is coming. The end of this cycle is coming. I have to be really cautious. A godly man is cautious and avoids danger. You see, if you know the cycles, you'll be cautious and avoid the danger. That's Proverbs. So you don't just put your money out there every year expecting, everything's going up, everything's going up, everything's going up. No. It also goes down. So you need to be aware of the cycles, because during the cycle, you're down, you know, and that's the part where you can lose your job. You could lose your income. You can't pay for the mortgage. You are in a very difficult situation. So you now need to think, well, is this the time to do this? Or should I be doing it some other time, you know? Or do I have the resources to pay it down quickly? If you do have the resources to pay it down quickly, well, that's great. Because then if danger is approaching, you can quickly change your position and you can still be in control.
Wow. Thank you so much. What about the 7 years business cycle? What does it mean?
Okay, the 7-year business cycle is where, you know, you have a lot of expansion in the economy, you have a lot of business activity, and then at the end of the 7 years, you'll have a dip. Generally speaking, it'll be 7 years. There'll be a dip. So business will dip down, demand will dip, consumer demand will dip. So if you were selling goods during, the up market, when the market is buying. It's fantastic. Everything's going great. But now if the market is changing and the demand is much lower because of circumstances, because of geopolitical events, because of other economic events, or even personal changes in personal behaviour, like in Africa, for example, we are now moving into a stronger economy going forward in Africa. People say, oh, that can't happen, but it is going to happen. You're going to buy an asset here very cheap, and in 40 years' time, that asset's going to be worth a lot of money in Africa, because the Western world is tanking economically, and a lot of those investors will be bringing their money to Africa.
Hallelujah.
Because the market in Africa will go right through the roof over the next 40 years, you see. So the smart investors are always already thinking, where will I go with my money if it's not working here in my home country? Things aren't going well. Interest rates have gone up. The market has tanked. We're hitting a brick wall. This is the 60-year K wave. We're hitting a brick wall. We have an aging population. There's not much spending anymore in the economy, because the 45 to 54-year-old age group are the big spenders in the economy, not the young people who've got debt, not the older people who are retiring. So you need to look at the economy. In Ghana, for example, the average age of the population would be, the average age would be maybe around 30 years of age. It's a fairly young population. And generally at that stage, there's family formation, they're getting married, they're buying a home, they're buying land to build, okay? And this is propelling the economy forward. So although at the moment we've had COVID, we've had restrictions, around COVID, for the reasons that government have introduced those restrictions because of health reasons. We are in a situation where the economy has changed. Cash flows have changed. Businesses have changed their way of doing business because they cannot perform the way they were performing before. They have to put staff off. They have to get their operating costs down. They have to make sure their margins in their products are still good because they're selling less product. If they're getting the same margin or a little bit less margin, then they have to retrench staff or they have to reduce overhead. So as the economy changes, all of these things come into play.
Okay, what goes into the 10-year capital gains?
Okay, they've done a study in Great Britain over, I can't remember exactly, but I think it's over 800 years. They've done a study over 800 years of property values. And they've worked out that every 10 years, properties double in value. So if you were 21 today and you bought your first property and you didn't do a flip, you might do one flip, but then you might keep the other one as a landlord property where you're landlording and you're keeping it for life. This one you're flipping to get some cash because you are taking the profit now. This one, you are sitting on this one for long term. So this one now will double every 10 years. And if you did a cash flow plan, a cash flow budget of your properties you're buying over the next 5 years, for example, or 10 years, you can see what will happen with your valuations, your net worth, and your debt. If you do a cash flow, you'll see exactly where your rents are going, and you'll have a picture of what you want to create in your life, the wealth you want to create. It can all be done on a cash flow.
Wow. That is so interesting. Let's go into property management. What entails that, please?
Okay. So as a landlord, essentially you are a property manager if you are landlording. Okay. If you are a flipper, you are flipping, buying and flipping, well then that management is different. You're really managing the money, you're managing the refurbishment, you're managing the repositioning of the asset because you know there's a demand for that asset in 6 months' time or 3 months' time. You know that you can sell it like that and take your profit. So if you bought it for 100,000, now you're selling it for 150, but you spent 20, there's 30,000 equity there. So you're now quickly selling it and taking the 30,000. And now you're using that 30,000 to put down as a deposit on another property. Or you might be paying some debt down, or you might be putting it into a long-term landlording property, for example, where it's going to keep going up in value over 30, 40, 50 years, the period that you're working, for example. You might find a creative way to buy a flipper on very little money, and you may just use a little bit of money to fix it up and flip it and make 30,000. Yeah, those deals can be available. Yeah, very quickly. They do that all around the world, okay? But those that you're holding long term, well, then those are the ones that you are creating wealth and coming back to how to become a millionaire in your lifetime. This is how you're doing it. You're landlording these properties. They're going up in value. You're not taking any risk. You're just letting them, you set and forget. You're letting them go up in value. You're looking after them. You're managing them. You're doing repairs. You're looking after the tenants. The tenants are crying about the stove. The stove is broken. Oh, okay, I'll come and fix the stove for you. You're keeping the tenants happy because they're the ones that are paying you. They're making you rich. The tenant is making you rich. So by managing the property properly, you are, excuse the expression, you are milking the cash flow to your advantage.
Okay, thank you so much. Under property management, let's talk about managing cash flow accounting.
Okay, so cash flow in a business is the same as cash flow in real estate. You know, you are managing cash inflow and cash outflow, and then you have net cash flow down the bottom, and then you have bank balance. Okay, so every month you are plotting your cash flows. You're plotting the money you're spending. You're plotting the money that is coming in, and you're working out at the end of the month, were you positive or were you negative? Positive being you made money, negative being you lost money. So in real estate, if you're flipping, for example, so on a cash flow you would have your cash inflow wouldn't come in until down here after maybe 6 months or whenever you sold the property. So the first 6 months of your cash flow is all outflow. So the purchase of the property, the renovation costs, tiling, painting, landscaping, all of those costs are coming out every month. So if you start with a bank balance of say you're going to spend $30,000 to renovate the property, okay, you must have an opening bank balance of over $30,000 because you know you're going to spend $30,000 in the next 6 months before you sell it and get your cash inflow. So it's an accounting function, okay, it's a cash flow. And a lot of people don't know about cash flows. I had to learn about cash flows the hard way, the very hard way. And you don't want to do that. You want to get some education on accounting, how to do cash flows, how to write a profit and loss statement, so that you can be in control of the money as you're doing the deal, and you know at the end of it roughly what you're going to get. If you sell it for a certain price, you know roughly what's going to come in at the end to pay back what you've invested and also to pay a profit to you. So it's an accounting function which is extremely important.
God bless you so much. Let's deal with these two things, and I believe the questions will cease here. Let's go into tenants and maintenance.
Okay. Once again, if you're a landlord, or even if you're a flipper, you've still got, maybe you finished the property, you put tenants in there, and now you're about to sell it, and it might take you 3 months to sell, so you've got tenants in there. So you've got to manage the tenants, okay, and you have to keep them happy. You can't just put a tenant in a property and say, oh, go away. You know, they're paying you money every week, or in Australia, in the Western world, they pay every fortnight, maybe every month. Here, you pay up front, of course. But, you know, in our culture, in our property investment scenario, we get rents coming in every fortnight or every month. And so, you know, you need to look after your tenant. Those people are paying you money to make you rich. So you cannot treat them badly. You cannot treat them, and the same here in Ghana, you cannot treat people badly who are your tenants, because the tenants are the ones making you rich. So you need to look after those tenants. If they have a broken stove or a broken window, you need to fix it quickly. And you need to, you know, look after them, whatever their needs are. You know, I mean, there's an extent that you would go to, of course, but you need to make sure that the property's in good repair, you know, not with water coming through the floor and you've got to go and rent another property somewhere because the landlord isn't interested in fixing up the property. That's just unethical, very unethical to do that. And still collecting the rent and letting all the water come through the property, and you've got to go and rent a hotel or a motel for 5 or 6 nights because there's water coming through your property. That's very bad. So what you're doing is, from an ethical point of view, it's to your advantage to look after that person or those people or that family. If you don't look after them, you don't have a business. Plain and simple.
Okay.
Uh-huh.
So let's talk about maintenance.
Mhm.
What is maintenance?
Again, property maintenance is where I just said, I'll use the example of the water coming through the property. You need to maintain the property in good and fit order so that your tenant is safe, your tenant is secure, and you've done the ethical right thing by the tenant. Because the tenant is gold to you. The money they're paying you is making you rich. So you need to make sure that that property is in good order and that you're looking after the tenant and that the maintenance you're doing is achieving that goal.
Okay.
Mm-hmm.
I repeated that again because I want the viewers to know how important those who are having houses that tenant are living. Most of the time you see the landlord and the tenant really fighting, and the landlord don't know that it is the tenant that make him or her rich. That is why I wanted you to repeat that for them to hear. That is their duty for them to know, bring peace,
yes,
and harmony,
sure,
to their tenant.
Sure.
Mr. Welcome. God bless you so much.
I want to just recap on that though.
Okay.
What we just mentioned, and the phrase I would use is, why would you cut off the hand that feeds you?
Wow.
The tenant is feeding you as a landlord. The tenant is making you rich. Why would you cut their hand off? They're paying you good money. So you should keep that property in good repair, and you should look after the tenant because they're making you rich.
Okay.
You see, people don't have that mentality necessarily in Africa, but in the Western world we do, because we understand that property values double every 10 years. So to look after a tenant in a property means that they're making you rich. They're bringing you a blessing. So you need to give them a blessing.
Okay. Mr. Welcome, thank you so much for a very lengthy discussion. And I'm so happy to connect with you about whatever thing that we've said. What are your last words for the viewers pertaining to all what you've said?
My last word would be study, study, study before you start. Because, as I said before, you could go into a deal or you could buy a property where you're over-leveraged or you don't have enough money and the property's going to sit there like the example of the landlord. He's built the property at 3/4 and he can't finish it. Don't go into those situations. Study, study, study. Learn everything you can before you start. I wrote reams and reams and reams of paper before I even bought a property because I wanted to be educated to the point where I had all the strategies in my head. And in effect, what I did was I did the deal in my head before I went out and did it, because I learnt to the point where I had all the strategies, all the understanding to enable me to go and do it in reality. And that's what I would say. My last comment is, make sure you are prepared before you go and do it.
Mr. Welcome, thank you so much for a very lengthy discussion. God bless you so much. God bless you viewers for being with us in this wonderful topic. I know that you are very, very blessed, and I know that you are very enlightened. I believe that you'll be expecting our next topic very soon. Thank you for staying in tune with us. And this is Prophet Langford. God bless you.